Traders now favour a 50 basis point rate cut from the ECB. That's as French PMI data disappoints. Euro area numbers break shortly. Boeing faces up to more strikes as workers reject the latest wage deal. The embattled playmaker warns it expects to keep burning cash next year. Plus, Tesla shares soar in after-hours trading after reporting its most profitable quarter in more than a year. Elon Musk sets out an ambitious rollout of robo-taxis. We're going to bring you the pre-market move shortly. Let's check in on the European markets map because the equity story is firmly there in terms of the earnings prints coming through. Positive on a number of fronts when it comes to Barclays, Hermes, Danone as well, all in the mix, lifting European shares higher so far in this Thursday session. The FTSE 100 here in the UK up 0.7%. Over in France, the CAC 40 gaining 0.6, despite the fact that PMI data there was soft on both services and manufacturing. Talking of which, on the data front, Euro area PMI is crossing the terminal right now. October services PMI falling to 51.2, a bigger drop than forecast. The expectations for a print of 51.5, services coming in at 51.2, a little miss there, a narrow miss. Euro area October manufacturing, meanwhile, you're seeing an increase. 45.9, the estimates had been for 45.1. Still firmly in contraction territory, of course, but German manufacturing giving the lift there, and we saw that data print earlier in the last hour. German manufacturing still in contraction, but slightly less bad than had been expected. Back to these markets then, the DAX is currently gaining 0.6%. The positivity coming through across these European equity markets, and the future setup in the stateside is currently positive as well. Let's flip the board and have a look at what's happening across the bond space. Pretty intriguing moves, certainly when it comes to the divergence between gilts here in the UK and treasuries. The sell-off that you've seen in US bonds taking something of a breather in the session today. You are seeing a bid for US treasuries, 420 on the benchmark 10-year, yields down 4 basis points. Different story here in the UK then. At the front end, 414 on the 2-year, a sell-off in gilts, passing words from Andrew Bailey of the BOE suggesting that services continues to be a concern for him and the central bank. Yields are up close to 5 basis points at the front end. Euro dollar 108, gaining from softness in the dollar. The Bloomberg dollar index, the last time I checked, was down 0.2%. The euro then getting a lift of similar measures. Brent $76.30, currently up 1.8%, and that is also tying into the positive session we're seeing here in the UK on the FTSE 100. The show starts right now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie, standing in for Francine Lacqua here in London. Now, two major US corporate stories leading the show this morning. Boeing workers rejecting the latest offer to end their strike, and Tesla deliveries and coming through with some blowout earnings. Also a line there as well in terms of a pickup in volumes expected from Tesla. Let's check in on the market price and then pre-market. Tesla popping, look at that, gaining close to 12% pre-market, almost offsetting the downside, around 14% year to date up until today. We'll see how that story transpires and whether or not investors will want more detail in terms of the outlook for next year. But certainly Elon Musk was sounding very positive, and the beat in the quarter feeding into the upside for Tesla shares pre-market. Boeing, very different story, of course. Members of that union rejecting that pay offer of around 35% increase. So that continues to be a challenge for the plane maker. Their earnings coming out as well yesterday, expected to continue with the cash burn through 2025. The stock down at 3% pre-market. Let's bring in right now Kate Duffy from my aviation team, Oliver Crook standing by in Berlin. Kate, let's start with you first of all in terms of the Boeing story. Why did they reject this offer?
Well, about 64% of Boeing workers rejected the new offer, and the new offer was a 35% wage increase over 4 years. So that's the majority of workers that rejected this. But what we're looking at here, the real sticking point, is the pensions. And this is something that they lost in 2014 in a deal, and Boeing isn't yet prepared to include that in the contract
This
offer.
is defined benefit pension award
that's
that they
right.
don't yet that they lost in 2014. So that's a
Exactly.
sticking point. What does this mean for Boeing then? How do they react to this? Do they go back to the discussions and negotiations? Do they play hardball? How do you think they react to this?
This means that Boeing and the union will have to come back to the table yet again. So this is the third time that they're doing this. It's all kind of wait and see game. We're not sure what's going to happen here. But basically, it's not looking good for the customers of Boeing, especially like the likes of Ryanair, Lufthansa, BA. They're all looking and searching for planes at the moment. Their fleets are aging, and Boeing just can't get their jets out of the door quick enough. They are producing round about one a day, and it's not enough for these growing fleets. You know, Ryanair, they've had to cut their passenger forecast, and they've also had to cut flight frequencies in their network. And BA and Lufthansa, they're looking for new deliveries of the 777X plane, and that's not going to come until 2026 because of the strike. So this is what we're seeing at the moment. There's a real backlog in deliveries.
It's hitting all ends of the ecosystem, isn't it? From the suppliers of Boeing to their customers. How does Kelly Ortberg adjust to this then? He was pretty frank about the cash burn expected in 2025. How does this new CEO navigate these multiple challenges?
Yeah, it's super hard. And yesterday, after earnings, he came out and he was very blunt about it and said, you know, we have to streamline Boeing. We have to focus all of the operations now into one. And we will see where that's heading. Obviously, they have the layoffs on the table as well. That's 17,000 workers that Boeing is planning to lay off. And he says that he wants to fix things, but the thing is that the strike has to be over before he can fix anything. You know, he wants to rebuild this culture. He wants to sort of put in these new business derivatives, and we'll see where that goes. OK,
Kate Duffy with the important update on Boeing. Thank you very much indeed. Let's switch focus to the automaker that is Tesla, of course, and bring in Oliver Crook standing by for us. Ollie, we're seeing the upside coming through pre-market for Tesla on the back of this beat and the outlook as well for the company. What did Musk deliver?
Yeah, so listen, Tom, I mean, we talk about the car maker. Actually, a large part of their revenue is actually not from car making in the third quarter. Almost 10% of it came from battery storages, which is a record for them in the quarter. Though we should say they also did sell a record number of cars that they've ever sold for the third quarter. They sold 460,000 cars in the third quarter. That is the third best that they've done in any quarter. So, Tom, amid all of this sort of questions about demand in the auto sector, slowdown globally, certainly in the question of EVs, this sort of number from Tesla is coming at a moment for this car industry where you've got profit warnings across the board and really bucking the trend. So really sort of with the numbers bouncing up and down, this sort of significant. And again, also we should mentioning, Tom, that there's other parts of this business that are growing, like the energy storage. They also made a ton of money, Tom, on their sort of EV credits, because as all these other car companies need to comply with really strict regulations across the world, we have new ones coming in Europe next year. Tesla is basically able to sell the credits of their own EV sales to these other car makers to make even more money. So with all of this sort of stuff jumping up and down in terms of their actual numbers, again, you looked at the EU September car sales, Tesla was up 30% in the month of September. So again, some positive stories in an industry that is otherwise facing very intense headwinds.
Yeah, as you say, look, it's important to break out the details, isn't it, in terms of the key catalysts for Tesla right now in these earnings. Ollie, there was also the promise from Musk to deliver in the future. We've heard a number of promises from him in the past, of course. Not all of them have come to fruition. How much should we put in these expectations, these forecasts that he's building out for the future of this business?
Yeah, so listen, Tom, we can deal with this sort of Musk fantasies. But again, Musk's great talent in certain things is actually being able to deliver on fantasies and build companies where other people just wouldn't even bother to try. Though saying that you're going to deliver 20 to 30% delivery growth next year may be a little bit on the bullish side, I think is fair to say. He's also saying that Tesla's going to be the most valuable company in the world. What's interesting is about the how he intends to get there. So one of the things that they're going to roll out next year is a more affordable car. This is not the mass market car that they had been talking about at a certain point, but something a little bit lower in the price range, which should hopefully for them stimulate demand. But then also the Cybercab, right, Tom? We saw that sort of Hollywood show that Elon Musk put on a couple of weeks ago and really talking about the future of the business. The problem with some of these things and also the ride sharing that he promised to roll out in Texas and California is it requires a lot of regulatory approval as well, and the technology can't be there. And Tom, here, it's probably worth mentioning the politics of all this. Musk has been a very strong advocate of Donald Trump in the presidential race. He's supposed to lead the Department of Government Efficiency potentially under Trump. So there's also a political potential tailwind for Musk if Trump were to win the presidency. And, you know, could he sort of get his agenda in terms of getting the regulations through in order to get this autonomous driving a little bit faster? I think that's another interesting part of this story, Tom.
Yeah, that is a fascinating prospect, isn't it? To what extent the funding that's coming through from Musk to that super PAC is going to pay off for him if Trump wins. Oliver Crook, thank you very much indeed on the details around the Tesla earnings and the prospects going forward for that business. And, of course, the CEO, Elon Musk. Coming up, we're going to discuss the latest in terms of the European PMI data and markets next. There's certainly a market reaction on the back of the French data. We'll get the details for you. Stay with us. This is Bloomberg. Welcome back now. Views among ECB officials about where to take monetary policy are starting to diverge as the 2% inflation target approaches for the central bank. Traders, however, now favour just a half-point rate cut by the central bank in December. Let's bring in Laura Cooper, global investment strategist at Nuveen, for a take on how to adjust around these markets and expectations on these central banks. Laura, is there an expectation that you would lean into? Would you lean into a jumbo cut from the ECB at the next meeting?
So I wouldn't yet lean into a jumbo cut from the ECB. I think there's been this greater scrutiny, certainly on the PMI prints that we saw today, but we're not getting a clean read that there's these downside risks to growth are actually building. And I think importantly, it's going to be about the inflation data. We have those clear prints next week. We are expected to see more of that goods price resumption pressures build, as well as we are expected to see, services inflation. Yes, it's broadening from a disinflationary perspective, but it's still quite elevated. So to our mind, it still suggests a gradual pace of cuts, evident to what Christine Lagarde is really continuing to emphasize.
Gradual pace of cuts. I have to say, I saw your notes dropping before the data came out. You said you're pushing back against 50 basis points. Then the French data came out, and I thought, that's a challenge for Laura. And then the German data came through, and it kind of underscores your point, doesn't it, to some extent? So markets now pricing in around 35 basis points by December for the ECB. How do you think about what's the read across to the European equity market then? Less aggressive than maybe the markets are expecting in terms of rate cuts, but the benefits are still there for some sectors. Tie that in terms of what we're seeing on the earnings front and how you're positioning on how much exposure you want to European equities and which parts of the European basket.
Yes, it's interesting because the European equity kind of landscape has been propped up in part by aggressive easing expectations, as well as kind of this multiples expansion. And to our mind, it's really going to be about earnings that's really going to have to do the heavy lifting from now on if we start to see some of those ECB easing bets pared back. So from a top-down perspective, I think there's still this need to be cautious on European equities. Yes, there are kind of those idiosyncratic earnings stories that do suggest to be selective across different sectors. Financials, for one, I think are going to continue to outperform. Utilities are another. I think the key kind of focus for us in the near term, though, will be around the rhetoric coming from kind of the potential election in the U.S. outcome. And that may kind of weigh on sentiment going forward, and that has implications for the equity market.
Yeah, absolutely. OK, so you favour financials, utilities in Europe. Let's go to U.S. politics then. Do you want to be leaning into the Trump trade at this point?
Well, I think markets are probably getting a bit ahead of themselves. I think certainly pricing in for a Republican sweep is premature. This is a very different dynamic than what we saw in 2016. I think what's been interesting, actually, in the U.S. rate sell-off is a part of that is kind of reflationary positioning. We are seeing inflation expectations rise, but we are actually seeing that term premium rise quite sharply. So, to my mind, I think investors are going to demand greater compensation for taking on long-end bonds. Even though at current levels they are attractive, I think momentum works against that. And as well, the U.S. election outcome, regardless of who is actually in that seat, we are going to continue to see extended fiscal deficits that does suggest we're going to see greater need for higher term premium. So there is scope for yields to continue to extend higher, I think, at this juncture.
How much higher, I guess, is the question. We're at 420 right now on the 10-year. Some have come out, bold calls around 5% by the end of this year on the 10-year. Does that seem like a reasonable expectation? Where do you see the 10-year ending 2024?
I think what's kind of been most challenging for investors in this current climate is the fact that we are seeing this rates volatility become pronounced. And I would suspect that's going to become really the key theme heading into the election until we start to see signs of what that outcome could actually be. I mean, our year-end target is still 4% for the 10-year. We think that's really where fair value is. A lot of that is being driven in part by, this extended sell-off probably gone a bit too far. But I think looking over the medium term, it's all about the inflation dynamics, the Fed dynamics, and we don't yet have clarity on that because we are still seeing this growth exceptionalism, fiscal deficits, a confluence of factors.
Okay, so there's a short-term to the medium-term view on the 10-year there. How is there complacency in the U.S. equity markets given the sell-off that we've seen and the repricing in the bond market?
I think it's been interesting, the fact that the U.S. equity market, yes, we continue to see record highs in the S&P 500, largely being driven by expectations for Fed easing, this firm economic backdrop, and as well this resilient earnings growth. So the key question is which of those pillars could potentially fall? We're going to see quite noisy economic data in coming weeks on the back of hurricanes and strikes and the payrolls, so that we won't get a clear read on the economic cycle. So then it does tilt us more towards earnings. The bar, of course, is exceptionally low. What's been interesting is actually the price reaction on the back of earnings. So those that have beat are actually not being kind of outperforming relative to history, whereas those that are missing are actually in line with what you would expect on a 5-year average. So to our mind, it does suggest perhaps the bull market is on thin ice. Still a need to be quite defensive, looking at pockets of sectors. Again, we still like tech despite stretched valuations, but it's really about dividend growers. It's about looking at kind of more of those defensive healthcare utility sectors.
Okay, a bull market on thin ice in the US. When it comes to the UK, do you want to be building positions in UK equities in the run-up to the budget on expectations, whether it's house building or banks on the other side? How are you thinking about the UK budget and how to factor that into your portfolio?
I think the way we're looking at the UK is really actually from the rates complex. I think it's been interesting that we've actually seen
more about rates than the budget.
More about rates than equities, actually, the way we're looking at the positioning.
Yes.
Yes, I think because at this current juncture, it's been interesting just how much gilt have sold off in tandem with U.S. Treasuries. Yeah. Against a backdrop that we don't think necessarily is warranted. I mean, yes, we're going to see tax increases. We're potentially going to see changes to the debt metric, which does bring about this uncertainty for investors. But if we look at where gilts are trading now, I mean, gilts to boons, they're retesting the wides that we've seen so far this year. We think there is value in gilts in this backdrop where we're clearly seeing the Bank of England suggest that disinflationary pressures are building much more quickly than they had expected. They could cut rates a bit more aggressively. We think there's scope still for some of that value to be unleashed in gilts.
Yeah, that spread of the UK 10-year, the gilt 10-year versus the German bunds, almost 200 basis points to your point. Okay, so maybe the sell-off in gilts, which is we're seeing again today with yields up 4 basis points on the 10-year, it has gone too far. Laura Cooper, thank you very much indeed. Excellent analysis across these markets as always. Laura Cooper, Nuveen's global investment strategist. Coming up with less than 2 weeks to go until the presidential election, our new poll puts Donald Trump and Kamala Harris in a dead heat. More on that next. This is Bloomberg. Welcome back. Now, the latest Bloomberg News Morning Consult opinion poll shows Donald Trump and Kamala Harris facing an extremely tight race. Both candidates are effectively tied among likely voters in each of the 7 swing states. Let's bring in Bloomberg's opening trade anchor, Kriti Gupta, for the latest on this. What have we learned from this polling? Because up until now, it's been pretty clear this is a tight race. This polling is focused squarely on the 7 swing states. How does it inform our views as we count down? Fewer than 2 weeks to go.
Well, I think we know the most is that we don't know. And I think that's the top line here, simply because the margin of error was already quite small. Yeah. Now you look at this polling, it's gotten even smaller. The one place, the widest point of that very, very tight margin is in Michigan. I thought that was fairly interesting in terms of, according to the labor vote, this was a real point of contention in terms of campaign strategies. The labor vote, the unions, for example, that have traditionally followed kind of a blue wave and pushed Democrats. Bernie Sanders over at Vermont is a big advocate for that. This time around, Trump did something that GOP candidates usually don't do, which is try to access that vote. He was unsuccessful in that. 2 out of 3 major unions in the states backing Harris instead of Trump. But you can see on that visual right there that the biggest margin is in Michigan, and it is coming to Kamala Harris. The other spots that you want to keep an eye on are, of course, Arizona and Nevada. That is where Trump is campaigning today. He's going to be trying to get those votes as well. And then Pennsylvania kind of goes back and forth, and that a lot of political strategists would say it's going to come down to Pennsylvania at the end of the day.
Yeah, the essential nature of Pennsylvania, that you need that in the basket in terms of those electoral college votes. In terms of, it's pretty interesting how the numbers are breaking down. You talk about Michigan, you talk about the unions, because, of course, the unions can back a candidate, but doesn't mean the members are necessarily, they have their own free vote, of course, so it doesn't necessarily filter all the way down. What do you think, you talked about that being a Trump strategy. What do you think the strategy is for both candidates then in the days ahead?
Well, it's interesting because the Trump campaign is kind of turning itself around in terms of some of the things that traditional GOP candidates say. For example, Democrats tend to push for early voting. It is a big, kind of very normal thing for Democrats to do to, again, court things like the female vote, for example, or to court a younger vote, court even a Hispanic vote. The idea being that we know what the policies you care about. Let's lock in that vote early, whereas GOP candidates tend to push for voting day itself. Trump is doing the opposite, which I think really speaks to the idea that a GOP candidate is pushing for that early voting simply by saying, if you're going to vote for Trump, you already know that you're going to vote for Trump. And that's something we've heard from the political strategists as well. But in terms of the strategy from the Harris campaign, it's important to keep in mind as well that she is making this a binary choice as well. You either vote for Trump or you don't. And that's where you've seen the comments of the last 24 hours really take the networks by storm.
Yeah, absolutely. And of course, it means if they do that early voting, they can zero in on the voters who have yet been persuaded. It helps the teams on the ground, doesn't it, on both sides. Kriti Gupta, thank you very much indeed on the update and what this poll tells us as we count down, of course, to that crucial US election. Coming up, we're going to discuss the path ahead for rates and the wider market outlook with the head of the Blackrock Investment Institute, Jean Boivin, is joining us next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Tom McKenzie in London. These are the top stories for your day. Traders now favouring a 50 basis point rate cut from the ECB as French PMI data disappoints. The wider euro area fails to grow for a second month. Boeing faces up to more strikes as workers reject the latest wage deal. The embattled playmaker warns it expects to keep burning cash next year. Plus, Tesla shares soar pre-markets after its most profitable quarter in more than a year. Let's check in on these markets then, and certainly earnings are feeding into the optimism we're seeing across European stocks so far this Thursday, having beats coming through from the likes of Barclays, Hermes, Danone, the yogurt maker as well, all tying into some upside in terms of the equities picture. European stocks are currently up around 0.6%. On the data front, we've been talking about the PMI data out of France and Germany. Here's the redhead then when it comes to the UK. Services PMI falling to 51.8. The forecast had been for 52.4. So that's a pretty sizable miss in terms of October services PMI for the UK. Still in expansionary territory, but below the forecast. When it comes to manufacturing, that is also a miss for the UK. UK October manufacturing PMI falling to 50.3, so just holding on to expansionary territory by the skin of its teeth. The estimates had been for 51.5. Let's check in on the pound on the back of this move then. Currently the pound just up 0.2%, versus the US dollar. The gilt markets have been selling off, and that sell-off has been paired to some extent in the session. Markets expecting still another cut, of course, from the Bank of England after they stayed put in September. Markets for the UK, traders expecting a 25 basis point cut at that next November meeting. That hasn't changed much on the back of this data, but you are seeing a bit of movement in terms of the sell-off in gilts has moderated to some extent. Traders now favouring, by the way, a half point. So from the BOE to the ECB, a half point interest rate cut from the European Central Bank in December. We saw poor manufacturing data out of France. Services data was also weak, adding to that impetus around a larger move. The wider euro area also failing to grow for a second month. Views, of course, among ECB officials on the rate path are starting to diverge. The Blackrock Investment Institute thinks the ECB will step up the pace of cuts. The Institute's head, Jean Boivin, joins me now for the view. Jean, maybe we'll get your views on the UK data in a minute, but let's start with Europe then. Markets are starting to lean in to expectations of a jumbo cut from this ECB. Would you follow that move? Is that the expectation with you and BlackRock?
Yeah, I think if we talk about the Europe in particular, and I want to contrast that in a minute from a broader story, but like in Europe, there's clearly like a slowdown. There's more of a traditional easing cycle that is required. I think there's a danger, however, that we start to extrapolate too much from jumbo rate cuts we're seeing everywhere. We've seen the Bank of Canada yesterday. We've seen the Fed earlier. So all of this dynamic, I think, in the case of Europe, there's a case for continuing to see disappointing data. However, I think there's extrapolation that go too far from markets, and the overall amount of easing we'll see globally, I think, is not as much as we hear right now. So ECB, yes. More to come. Not sure about 50 basis, but there's more easing. However, these easing cycle expectations, I think, are overdone overall.
Okay, so more broadly, overall, easing expectations overdone. So markets ahead and over their skis a little bit on that front. You do think the ECB is going to step up with further rate cuts. You're not sure about jumbo. When do you think they get below 2% in terms of the main refinancing rate for the ECB? Does that come in the first quarter, the first half of next year?
I think this is very unclear to me, at least so far, because I think you could see a case now, given the current momentum, where we get there at some point in 2025 first part. But at the same time, our core view is that the inflation story globally is not over. And I think over the course of the next few months and quarters, this narrative will change around that, and that can give them some pause to go further. So I think we see some easing, some conviction over the next quarter, let's say. A case maybe where we get closer to 2 in the first half of next year, but I don't think that is a given.
How much of an incentive would that be then for investors to get further exposure to European markets? The growth is clearly not there. It's certainly challenged, but you are getting these rate cuts pushing into 2025 is the expectation. How does that lead into your view around how much exposure you want to European stocks?
Yeah, no, I think this is the challenge right now. So, and to us, the risk asset story, and the reason why we're bullish on risk assets more generally is not so much a macro story. It's not about rate cuts. It's really about the powerful engines of growth that we're seeing in some places, and it's about what we call mega forces, but AI in particular. So it's more thematic. I think that leads us to be bullish on some risk asset and equities, but that tends to favor right now the U.S. as opposed to Europe, given that the AI story is really much U.S.-centric right now. So it's not so much a macro rate cut story, but more about these forces.
Yeah, and Blackrock and you and the team have been clear about the AI theme and the persistence of that. You've pushed back on the concerns around ROI, for example, in terms of the CapEx spend and the investment that comes. You still think that's a key driver. But you're also talking about a broadening out of the market in the U.S. Does that come at the expense of big tech at some point?
I think there's a couple of things here, right? The first thing is that this AI story, which is the transformation of the makeup of the economy, I think has to imply some concentration as a result of that, because the big player, the one that can build out the AI, have to be at this moment the bigger players. It's difficult for a new entrant, small, to have the balance sheet to build data centers. So as a result, I think the concentration we see will remain a feature of this market, but as we get more enthusiasm around that, as we start to see some adoption in other sectors and so on, that's where the broadening out will eventually come. But so we see some coming, but it won't be at the expense of megatech. It's going to be actually caused by the megatech.
Are there any obvious tactical trades to be placing ahead of the US election right now? Or would your advice to clients be stay on the sidelines until we get clarity?
I think it's a full errands game to try to trade the U.S. election. You would tell me today, I know for sure which party will win, and I would not know how to trade it, to be honest. I don't know how the market will react on the next day. For us, the main thing to watch is really more the contested election scenario that could be weeks of very disrupting legal battles.
Is that underpriced by the markets, do you think, that scenario?
I don't think that's in the price, and that's where, if you want to, prepare for some scenario where you need to react, I think it's one of those scenarios that could be bad for markets on November 6th, sorry. So that's one thing, but other than that, I think it's very difficult to know, which way the markets will go once we learn the outcome. And I think over the long term, the implications will be something we'll learn, because, there's some things are being said, what will be implemented could be very different. So
there's one argument, I hear that, absolutely. There's one argument that what is uncontested is that there will be further fiscal expansion from whoever is in office. So how does that inform? Does that mean you're shorting the long end of the Treasury curve? How do you want to be thinking about that scenario? That seems to be a little bit more consensus on that view.
So there's a few things, but totally, I think that's not about the outcome of the election, because we take it as a given that deficits are coming, will continue. It has been our view for some time that we're in an environment where inflation is already an issue that is not fully resolved. Central banks will not be able to cut as much as the market is currently expecting. And on top of that, we think post-election, it will be clear that this deficit story is real, right? And so I think this is an environment where long-term rates eventually start to go up. We've seen a very significant repricing over the last month, since September, right? 60 basis points. We think that has room to continue over the long run. And so it's not really an election trade. It's more like it's kind of baked in the macro environment
when does it trigger the bond vigilantes in the US? Which the US has seemed to be immune to the bond vigilantes in recent years. Are we approaching a tipping point?
I don't think we're approaching a tipping point. I mean, bond vigilantes, like sharp movement due to like sudden fears about things getting out of control. I think it's a tail scenario at this stage. Partly because the U.S., reserve currency and all of the importance it has globally prevents. It's costly for bond vigilantes to go hard like they might have been doing in the UK 2 years ago, right? So that dynamic is different. It's not impossible, but I still think this is a...
Well, talking of the UK and drawing on your experience at the Central Bank of Canada, how much room do you think Rachel Reeves, the Chancellor, has to expand borrowing here before the debt markets start to push the panic button?
Yeah, I think the bond market has already been pushing a lot of concern on the fiscal side. So we've turned more positive on UK gilts because we think these concerns are overpriced, and the Bank of England has room to cut, and the economy is not necessarily in a great shape. So all of that means that the yields movement we've seen, the high yields, are not fully justified at this stage. So it doesn't necessarily give room to spend because, I mean, this is a pretty fragile equilibrium. But I think there is some room, and in fact, we're a bit more constructive on the fiscal outlook and what it means for yield than
Okay, yeah, very interesting. The budget, of course, will be announced next week, so we'll be watching that with a close eye, as I'm sure you and the Blackrock team will be as well. Jean, thank you so much for walking through a number of different macro economic topics and, of course, a closer take on these markets as well. Jean Boivin, who is the head of Blackrock Investment Institute. Coming up, bank earnings bonanza. We're going to unpack a busy few days of results from some of the big lenders with Viki Farmaki from State Street Global Advisors. So a deep dive on the financials. That's coming up next. This is Bloomberg. Welcome back. Now, Barclays shares have jumped after reporting earnings. The British lender's profit was buoyed by an increase in trading revenue in the third quarter. You can see the stock is up 4.3% so far in the session. It also expects Barclays' full-year net interest income to be greater than £11 billion. That's up from an earlier forecast. So it's been a strong year for the banking sector overall, both in Europe and over on Wall Street. Certainly a strong quarter so far, where US banks, of course, have delivered better than expected third quarter earnings as well. Let's discuss the broader sector and how the earnings story informs the next steps for these banks with Viki Farmaki, senior analyst at State Street Global Advisors, with a lens on the financials. Viki, thanks so much for joining us in the studio.
Thank you for having me.
Let's start with a broad question then. The earnings broadly, as we said, have been broadly positive for this sector. Are we at peak earnings given what's happening with rates for the banking sector?
Well, let's start with the setup for Q3. It's a very constructive one. I think we're going to get reassuring results. We've had some rate cuts, but it's early days yet to have an impact. So I think overall, the investors are going to look through the Q3, which is a pretty good setup, you would agree, and what the guidance will be. And here we have some banks that are possibly through peak earnings, so that's what investors are concerned about. But there are other banks who are less interest rate sensitive because of the way the books are balanced, the way the deposits are structured, and, of course, the macro backdrop that they have. So I think you have quite a divergence going forward. Investors are going to look for that guidance of who's going to be more or less interest rate sensitive. A big part of that is where the ECB rate will land, where the lower bound will be going forward. The 2 to 3% range is what bank management teams tells us is a pretty good rate. Below that, below 2%, it starts to get more tricky. So I think that's what we're going to be looking for.
Okay. And that sort of time, and of course, the discussion right now is whether or not you get a jumbo cut even from the ECB. So that could be bad news for the banks. And you're looking at markets pricing in sub 2% on the main ECB rate by June of next year. So what is the lag in terms of lower rates and the squeeze on net interest income for these European lenders?
Absolutely. I think, again, it would depend on the country you're in. And how the books are structured. We have countries like the UK and France and some of the Netherlands where hedges are in place, and that would definitely smooth how far the net interest margin impact will be. But then you have other countries in the periphery that are going to be hit quite quicker as they benefited quicker going on the way up. So I think you will have this divergence between different countries and how the different books are balanced. And then you have the diversification of the revenue streams. And we're definitely looking at that and where fee income will play an important part to offset some of that impact.
OK, because the flip side is possibly higher loan growth as a result of lower rates. How are you seeing that in terms of offsetting a potential squeeze in net interest income? What are we seeing in terms of loan growth? Are we seeing a pickup there?
Well, so far has been pretty subdued. We haven't seen that come through quite yet. But we did see the ECB lending surveys come out for the third quarter. And we're seeing very positive signs there, especially on the household. We had household demand surge for the fastest rate since Q2 of 2015, actually. And even on the corporate side, we're seeing a pickup for the first time in a year. So the green shoots are there for low demand, but it's very early days. We're looking to go from about 0% growth to maybe 2 to 3%. For some banks, that's not going to be enough to offset the net interest margin. A hit from the interest rates for others that have other sources of revenue, it will be able to continue to show earnings growth. So maybe 2 to 3% growth in loan growth for next year, presumably. That's the view. OK, interesting in terms of the positive catalyst for these banks. Deutsche Bank came out with earnings yesterday. Of course, I know you don't talk about individual names. It was a beat top line, but real concerns about credit provisions. More broadly across the sector, are you seeing a marked and significant and material tick up in terms of provisions, in terms of credit losses at these banks? For the sectors overall, we're not seeing any asset quality issues emerge. The starting point is very low. As you know, credit losses have been well below historical averages, and that's because we haven't had much loan growth. There haven't been aggressive underwriting taking place. So overall, asset quality remains very benign. But we do expect it to pick up. We expect the credit losses to come up from very low levels, and most bank management teams are guiding to that. But again, it's nothing that will be a systemic issue at this stage, and capital levels are very high. They are 15%, which is double what we had before the financial crisis. So they come into this with very strong capital positions and from very low credit losses. So we do expect a pickup, but we haven't seen any.
Okay, it's not a black swan for this sector. OK, the provisions, or at least the balance sheet is robust enough. What about next year as a theme in terms of consolidation? The UniCredit stake in Commerzbank, what's happening, of course, with Sabadell over in Spain. Do we see real consolidation in this European banking space next year?
Well, we do need consolidation in Europe.
We need it, but we're going to get it.
Well, that's the question. I think we need consolidation. We need banks sort of scale and efficiency. But each deal that's announced has to be assessed on its own merits. And the shareholders have to assess whether it's accretive. We see in-country deals make more sense. And there you can see the synergies materialize much easier. But what we're also seeing with banks is now that they have the capital, the flexibility, they can think more strategically about the businesses that they have for a couple of years. So they're thinking about M&A. They're thinking about bolt-on, where they can improve their capabilities, especially in the fee income side, because we talk that's going to be a key driver to offset some of the pressure we're seeing on the net interest income side. So we're definitely likely to see more M&A, whether it comes with big banks or more bolt-ons is to be seen. OK, so if we get more in that's interesting. If we get more in M&A, does that mean we get fewer buybacks? Because banks have been pretty generous in terms of the return of cash to right
shareholders.
Now,
does that become less of a catalyst next year?
Well, capital levels are very strong, so banks have the flexibility to do both at this stage.
OK.
They have quite good capital levels, and they're managing that, and they're balancing the interests of the different shareholders. So a lot of them are able to put some money on the side for buybacks and also pursue their strategic initiatives. OK, both M&A and buybacks then in the pipeline for these banks. Great insights in terms of how this sector is shaping up to a modestly lower rate environment, but of course historically high, at least over the last few decades for the banking sector. Viki Farmaki from State Street Global Advisors, seeing loan growth as well, increasing maybe 2 to 3% next year. Coming up, we're switching focus to the luxury space. Gucci owner Kering warns its annual profit will fall to the lowest level since 2016. That's as Chinese shoppers shun the luxury sector, at least parts of it. Not so much for Hermès. We're going to bring you the details next. This is Bloomberg.
Wednesday, Chancellor of the Exchequer Rachel Reeves delivers the UK's annual budget, the first for the Labour government after 14 years in opposition. How will the Treasury balance investing for growth while dealing with the deficit? And which tax increases will she use to meet the challenge? Live from Westminster, Bloomberg Television brings you special coverage, starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. Bloomberg. Context changes everything.
Welcome back. Now, the slowdown in Chinese demand for designer goods is taking a toll on some of the world's top luxury brands. Gucci owner Kering today warning annual profit will fall to its lowest level since 2016. The stock moves, of course, reflecting more the optimism that's come through as a result of Hermès, which is giving the broader sector a lift. Let's bring in Angelina Rascouir now for a deep dive on what we're seeing in terms of the luxury market. It seems to be, if you ignore today's moves, it's a tale of two luxury spaces. Hermès on one end and everyone else on the other. Angelina, what have we learned?
Yes, absolutely. Today we got the confirmation that indeed Hermès, because of its they target basically the wealthiest customers, and they tend to be the most resilient. So right now we're facing a downturn overall in demand, and but they said especially in China, their most loyal customers in the third quarter still splurged on its priciest products. So that's jewelry, that's ready to wear, and that's leather goods. And that's not the case for the rest of the sector. So today the shares are up, and overall, I mean, they grew by double digits in the third quarter. And importantly, the CFO told us that so far early this quarter, they're not seeing a change in trends.
Yeah, that trend's going to continue. What is it, 11% increase in sales versus what, 25% drop for Kering? Talk to us about Kering then, Angelina. They cannot blame everything, can they, on China? This is also about problems within the business.
Yes, exactly. There's a macro picture, but there's also problems of their own making. And Gucci, as you said, results were down. Revenue was down about 25% in the third quarter. And the issue is that when Gucci struggles, Kering struggles, because even though they have Yves Saint Laurent, they own Balenciaga, Bottega Veneta, that's not enough to compensate for the struggles at Gucci. And so indeed, the issue with Gucci is that it's been in turnaround for a long time now. So quarter after quarter, we get more negative results. And so yesterday they warned that basically annual profit is set to be to reach the lowest level since 2016. So that's a big disappointment for the market. And there was also in the analyst call a few visibility for next year. So we'll see what happens. But it's true. I mean, they named a new designer early last year, so he's been there for about 18 months. He's presented a few collections, and we'll see if customers appreciate his designs. But indeed, it comes as the macro picture is really worsening, especially in China.
Yeah, the two things coming together, and the executives saying that they still support the designer, and the more kind of pared back. Maybe less extravagant look that's come through as a result of that design. Angelina Rascouir, thank you very much indeed with the take there in terms of the earnings that come through from Hermès and Kering. Very different picture from both of those luxury companies, of course. The stocks, though, across the luxury sector getting a lift, and that's helping the CAC 40 so far in the session gain around 0.7%. Pre-market, we are looking at Tesla and the pop that's come through on the back of a blowout quarter, and some guidance as well in terms of volumes, and they're doing very well in terms of the battery, the energy storage, but also the credits they sell to other automakers. Pre-market, Tesla up close to 11%. Boeing, though, the woes around its workers not accepting that deal, that stock is down 3%. Executives expect the cash burn to continue into 2025. Up next, it's The Brief with Danny Berger and Manus Cranney in New York. This is Bloomberg.